I will be sharing. I'll be sharing my screen on the basic terminologies you need to know before you venture into features. The basic terminologies you need to know before you go into futures trading. So please, if you are seeing my screen, please type one in the chat, please. Please, if you are seeing my screen, please type one in the chat before I continue. Okay. So let me play it. So if you are hearing the sound, let me know.
Excellent day to every one of us, whatever you are watching this tutorial. Now, we have finally reached. Uh,
Are you hearing the sound? Type yes if you're hearing the sound. Type yes if you are seeing my screen. Okay, let me go ahead. So let's pay attention.
uh, One of the best way of making money in crypto. In the last video, I was talking about trading, futures trading. So, in the last video, I was talking about spot trading. I was talking about spot trading, but in this tutorial now, I'll be talking about futures trading and terminologies you need to know. Compared to spot trading, we are going to see one of the advantage of why futures trading is more beneficial, far more beneficial, more rewarding, more profitable than spot trading. Although it comes with risk and the potential of you losing all your money, but with the right fund and risk management and with a good strategy on how you trade, you can hedge against all these loss so that this fear of losing, that's one of the things that scares me far away from futures trading. But since I started doing futures, I've made a lot of mistakes, I've lost money. So I've known the reason why I lost those money, and I've made several profit from different trades. I've done more than several trades in the past few weeks. That's why I can be able to explain futures trading. Because when I wanted to do futures trading years back, I didn't really understand. It doesn't make sense to me. I couldn't, because the definition for futures trading, let me just give an example. If you go online to go and ask for the meaning of futures trading, it is so complex. You will not be able to wrap your mind, your brain around the definition. So the way they talk about it, you will not be able to even get a grasp about what futures is all about. We see now, they say put simply, futures trading is the trading of a derivative at a future time at an agreed price. When trading futures, one is trading based on a contract that specifies time and price. The origin of futures trading can be found in a concept called forward contracts. With a forward contract, two parties agree to sell an amount of an asset for a predetermined amount of money at a specific time in the future. So when I check all this definition, to me, what is derivative? So the definition of futures trading, derivative trading, really make I can't really understand it until when I practicalize it, and I can give you a definition in a layman way that you can really understand futures trading. Because if you are using all these definitions as a layman that have not engaged in trading before, you'll not be able to understand. So that's why I'm breaking it down to a layman understanding. Now, for me, futures trading compared to spot trading, in my previous video, I spoke little about it. Futures trading is like you are borrowing money from the exchange. That's one of the ways I can easily explain it. It's like you are borrowing money to trade. You have small money, just like you're a business owner. All the money you have as an upcoming business owner is want to engage in maybe you want to be selling a particular goods, and all you have is $40. All you have is $40, and this will limit you. And you need about $600. Let's say you need like $400 to actually get those products. But all you have is $40. As a normal person, you as a business owner, you want to look for a way to leverage so that I can get more capital, so that I can get more, or you want to get $600. All you have is $40. All you have is $40. Then the normal thing you do as a business owner or a trader is you approach a financial institution, or you look for where you can borrow money if you want to get times 10 of what you have to give you $400, or you want to ask for times 15 to get $600, so that when you buy those goods, instead of you just using $40 to buy that goods, and you make 5% profits, 5% profit on this $40, which will limit you. You will be making like let's say $2 as your profits. But if you leverage, you go and borrow money to trade, to go and buy that same good, and you take 5% from this $600 that you borrowed, you'll be able to make 10% is what? Is $60. You'll be able to make $30 compared to making $2 as your profit. As your profit. So futures trading is more or less like you have small money and you want to in exchange to borrowing money to trade. So normally when you approach banks to borrowing money, they want to ask for your collateral. They want to see your business, how viable it is. They want to see your business plan before they borrow money. And if they borrow money and you're unable to pay that money back, they will collect that money from you. They will must get that money back from you that they borrowed you, and even your collateral will get it from you, and you might be left with nothing. So borrowing money is risky. So future trading is like borrowing money. So someone that is in sport trading, in sports, you want to borrow money. Someone that wants to do normal sports, all you have is $100. $100 to buy. Let's say you want to buy a coin called XRP coin. This is all the money you have, $100. Now, if you put all this $100 to buy this XRP coin, and you want to take 3% when the coin goes up, you're only going to make 3% of $100 will give you what? $3. If you go for spot trading, and any asset you buy on spot market using spot trading, the entire asset together, say you bought how many quantities of XRP, like 100 quantity of XRP is yours. Even if the coin go up and down in value, is yours. But in futures trading, it's not like that. Futures trading is not like that. So in futures trading, let's say you have that same $100. You want to buy XRP coin, but you want to leverage. You want to buy more of. You want to get more of XRP and get more profit. So in future trading, you don't need to use all your $100. You can just use $10, $10, $10 from your balance. Use just $10, $10 from your $100. You having a balance of $90. Then with this $10, you still have a $90 balance. You don't need to use everything. I will tell you the reason why. With this $10, you can go and approach an exchange that you want them to give you $500 with this $10. $500 with this $10. Then when you now engage in that trade, compared with the same person that made 3% with only $100, he committed all this money, but you are just using $10. You use leverage, you borrow from the exchange, they borrowed you 50 times of this $10, they give you $500. Then When you now enter a trade, if you take 3% on that same coin, you will be making how much? 3% of $500, you'll be making $15 as against someone that is making $3 with using his own capital. But in future trading, you can even make more than the $15. When I get to leverage, I will explain what that means. So this is just a brief explanation what future trading is all about. You use small amount of money to buy a coin. You now leverage by getting 10 times, 20 times, 30 times, 50 times, as even as 70 times of what you have. So that you can be able to buy more quantity and be able to make more profit compared to spot trading. So that's the short definition of what futures trading is all about. So I will now go to the next topic where I will now be breaking down several terminologies that you need to understand in futures trading.
So now let's continue. I will now show us, give us more breakdown on some terminologies that you need to know in futures trading. But there are so many terms that you need to know in futures trading that when you begin to see those terminologies, it will not be strange to you. It will not be strange to you. So is there any question before I continue? Any question so far on definition of what future trading is all about? Okay, if there's no question, let's continue. Okay, let's continue if there's no question.
In this next video, I'll be talking about what is leverage, what is margin and size, what is order, what is position. So let's continue. Now, in the previous video, I tried to explain what future trading is. Now, what makes future trading unique is what we call leverage. Is what we call leverage. Lever, bridge, leverage. That's what makes future trading to be unique. You know, in physics, in science, if you have done science before, uh, we have something we call lever or fulcrum like this. If you want to carry a luggage that is very heavy, even a small boy can use this leverage to carry. This boy is just maybe 30 kilogram in weight. He can be able to use leverage to be able to carry maybe 150 kg with this lever. So when you put If you want to, he cannot carry this in by himself, or he can use this system to carry this load by using this lever. If you just put this thing down, this thing will go up. Don't need to carry by himself. Another example of lever or leverage is somebody a wheelbarrow. 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 Um, you cannot carry a luggage by yourself. Maybe you want to carry a luggage of 100 kg by yourself to lift it up. You want to carry a luggage. This is you. You want to carry a luggage of 150 kg and you are just 40 kg, or you are even 60 kg. It's for you to lift is very high. But if you can just look for a wheelbarrow, this you drive the wheelbarrow, you can now put a luggage of 150 kg here and you can easily push it. So leverage helps you to get things better, getting easier, and it will give you more better results. So in futures trading, in futures trading, in futures trading, what makes futures trading to be much more beneficial is leverage. Somebody having only $10 and he can be able to get $500, and all he has is $10. All he has is $10. So that's what makes future trading to be very, very rewarding and also very, very risky. Because if you enter a trade and the market goes against you, if you don't have proper fund, if you have proper trading strategy, proper fund management, proper risk management, you lose not only this $10, the remaining money in your account, you can lose everything. So in futures trading, we have leverage. Somebody has $10. That's why when you go to the futures trade, when you want to place a trade, you will see when you want to place a trade, you have only, let's say, $30. You want to just use $3 from $30. I'll tell the reason why later. And you want to, when you go to, when you place an order, once you enter a trade, you will see that when you want to get a leverage, you will see something like a meter like this. Meter. You will see 10x, you see 20x, you see 30x, you see 40x, you see 50x, as high as some exchange can give as high as 75x. Meaning that if you want if you want to get 10x, that means you want to just get $30 to trade. If you want to get 20x leverage, that means you want to get $60 to trade. If you want to get 30x leverage, that means you want to use $90 to trade. If you want to get 70x leverage, that means you want to use $210 to trade, because 70 times 3 is 210. So you're not using the $3 to trade again, you'll be using $210 to trade. So when you want to take your profit will be used. This your size is what this size of the amount you have is what will not be used to. So it will give you more money compared to using spot trade. That's why um, futures trading is very, very lucrative. So this is just a brief explanation of what leverage is all about. So let me also now talk about the next topic. I want to talk about what is margin and size. What is margin and size? These are terminologies you'll be seeing when you want to start trading. So that's why I have to break it down. So let's say you have $30, all the money that you have is $30. Now, the rule in futures trading is that only use 5% to 10% of your capital. That's number one.
Let me pause that place. When I started this, when I was creating this video, that was the percentage I was recommending. But now I recommend lower than this, because if we are using 10% of your capital to trade in normal future trading, is too high. 10% is too high. So that's what those are the reason why I was liquidated. I was using 10% of my capital. Let's say you have $50. I'm using 10%, which is $5. It's too high. And especially if I'm not using high leverage to trade, it's too high. So I recommend 2% to 5% of your capital. 2% to 5%. I need to first clarify that place before we continue.
Fund and risk management. Don't ever use the entire $30. Even if you have $100, use $10. If you have $200,
Ah,
use $20 or at most $30. The lower percentage you use, the better for you. That's what will be able to safeguard you from. That's one of the number one risk management. So when you talk about what is the meaning of margin. So the $3, I'm talking about margin now. Margin. So the $3 that you committed to that trade out of the $30 you have is what we call margin. That's what we call margin. That's your margin position in that trade. No, you still have $27 balance. Now, what is now size? Size. Now, it depends on the exchange. The size in your future trading is, now you use only $3 as your margin out of the $30. Now, based on the leverage that you use, let's say you use 50x leverage.
that's enough.
Then, if you multiply 3 times 50, your size will not be what? Your position size will not be what? $150. That's your position size. That the exchange will see that this is the total money that you have now for trading compared to this one. So this is a size that you have committed to that trading, your futures trading. So that's the meaning of size when it comes to futures trading. So let me continue. Let me go to the next point. The next point I want to talk about is what is order. What is order? Now, when you want to trade, when you want to trade, um, when you want to trade, sometimes like in Binance and in Bybit and some other exchange, when you want to trade and you don't want to enter at the current price, let's say the price of the coin you want to enter currently is $1.2 per one, but you don't want to enter at this current price, but you want to enter when the value of the coin goes down to $0.9. So when you now place that order, because you didn't enter the current price, your trade will not be active, it will not be running. You have not taken a position in that trade. So when you place that trade, that place is what we call order, because you just place the order, just like somebody that want to buy something from Jumia, So you place the order on Jumia, and the product has not reached you. It's on the product reach you that you can receive the product. So when you place an order, you are waiting for the order to meet you, and you can be able to see what you order for. So in futures trading, when you place an order, maybe at a price higher than the current price you are seeing in the market or lower, that's what we call order. And you see it on the exchange at the bottom. It will not show. The trade will not start running. That's what we call order. When I practically show us on the exchange, you'll be able to understand. Now, what is position? What is position? Position in futures trading. What is position? Position. What is position? Position. Now, as compared to order that I just explained,
Please mute your mic, please. Mute your mic. Your background is reflecting, please. Who is mute? Please mute your mic.
just explained before now. Now, let's say you have that. Let's say you have $15. You enter a trade with $5 margin. Then you use a leverage of times 50x leverage, 50x leverage times 5. Then your size will now be what? $250. So the moment you start that trade, the moment you have already started that trade and it's already running, waiting for when it will sell to give you profit, when it will close to give you profit, that order, the order that is now activated is what we call position. You see it on your exchange. You see your trade going up and down, negative green, negative up and down. So that position you have taken in that trade is what we call position in futures trading. You see it when I start doing the video. I'm just giving these terminologies now. So when I begin to do the video, be able to it be clear. It be clearer. So the next thing I want to talk about is long position. Long position. Long position or open long. Long position or open long. Now, when you want to trade in futures, we have two positions you can take in futures trading. Number one is called long position or buy position. Let me call it long or buy position. What does that mean? When you enter a coin and the coin has gone down, and you want to enter that coin from the bottom, from here, it can still go further down. But once you enter a position here to buy, you want to long, that means you are expecting that the coin is going to go up. So you are placing an order from the bottom here. You are buying. You are taking a long position. You are taking a long position. That means you are buying from the bottom with the expectation that the price will go up, then it will close. That is what we call long position or open long position. You see the button on the exchange, either open, like we want to open, we want to take a long position. That's what long position means. Then what is short position? What is short position? Short or sell position. This is a position you take to trade when you know that this coin has already gone up in price. It has gone up in price. It has gone up, and it has reached the highest price, the all-time high. And you have done your analysis that this coin has the tendency of coming down in price. So the position you take at the top, the position you take at the top here, knowing that the coin is going to come down in price, maybe you enter the coin at $3, and you have the position that this coin will crash down to $2.0. Then the position you are taking from here is called short or sell position, because you believe that people will be selling this coin because it has reached the highest and people will be selling it to be coming down. So the sell position you are taking is a position that the or this coin will be going down. So you want to take a position from it as it's going down, you want to be making profits. Imagine this coin that you enter goes down by 15%. You don't want to know the kind of profit you are going to make. So that's what makes uh, sports trading different from um, um, futures trading, because in spot trading you can only enter a coin when the coin has crashed down. When the coin has crashed down, maybe you enter, the coin was $4 before. No, the coin was $4 before and it has crashed down. So in spot trading you can only buy and expect it to go up. But in futures trading, you can take a long position from bottom knowing that the coin is going up, or you can take a position from higher knowing that it can come down in price and take your profit. So this is just an explanation of what long and short positions are all about. I think I need to reduce this video. I will now talk about this other 1, 2, 3, 4, 5 points. Excellent day.
So let's move to the next topic. I'm coming.
So in this next video, I'll be talking about what is entry price, what is market price, what is TP, what is SL, what is liquidation, and liquidated price. Now, what is entry price? These are the things you will see when you start trading. What is entry price? That's easy to understand. What is entry price? The entry price, whether you are taking a short position or a long position, is the price that you enter a trade. Let me first explain with long position. Long position. That means you want to take a buy order. Let's say you want to enter a coin at $3. So whether the coin goes up to 3.5 or goes down to 2.5, your current the entry price, no, the entry price, the price that you enter is this $3. You see it. Or whether you even take short position, entering from the top coming down. So the entry price that you enter, you'll be seeing it. The price you entered is what we call the price that you entered, the price that you bought that coin. Whether you bought it with long position, or you bought it, or whether you short it. That's what we call entry. But the price that you entered is called the entry price. Now, let me now go to the next point. So, what is market price or current price? The next point I want to talk about is what we call market or current price. Current price. In the example I told us before, that your entry price, let's say your entry price is $3. $3. That was the price you entered. But the price does not stay in one place. The moment you enter that trade, it begins to fluctuate up and down, 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 up and down. It will be fluctuating. Now,
The market price is the current price that you are seeing in the market. So let's say this is the price that you enter this coin. The coin might have gone down maybe by minus 0.5%, minus 1, that has gone down by minus 1%. So let's say on the exchange that you are trading, you will see it there. Beside it, you will see that, let's say your market price now is $2.2. So this is the market or current price. This is your entry price. This is the market price. And this current price show that this market price show that the coin has gone down in value. So if the coin is, let's say, 3.8, you enter at $3. So this market price or current price show that the price have gone up in price, then you're in profit. But if you go down, let's say you are taking a long position. And if you take a long position, let me explain that place very well. When you take a long position that you want this coin to go up and you sell. So if you enter at $3 and the coin has gone up by 3.8, that means you're already in profit, maybe by 10%, 5%. The price have gone up. But when the value go down, it does not mean you have lost. The value of the coin, the asset has depreciated. So you might be in negative. You'll be seeing negative. So it means that you enter at $3, but the market has gone against your expectation. If the current price is $2.2, that means the coin has depreciated in value. It has gone against your expectation of it going up. So it's been going up and down, up and down. So when it's going up and down, don't be shaking. Don't be it happens, it's normal. We can be emotional. That's why the moment you have enough fund management and risk management in place, you don't need to bother. If you have done your analysis very well, just keep calm. It happened to me yesterday. I entered a coin, a very volatile new coin. I entered it 3 times. I entered long position, first time, second time, I entered short position, third time it went down. I entered the long position that is will go up, it started going down, started going down. So if I didn't apply fund and management, fund and risk management, I would lose my position. I can lose partially if I use stop loss. If I um didn't use stop loss, I can be completely liquidated, meaning that all the money in my wallet, if I have $30, I'm using $50, $100, everything will be wiped off. So that means the market went against me. Now, let's say you are doing short position. Short position. I'm still using an example of $3. You enter from the top. You enter from the top when the coin went up. You enter from the top at $3. And you have the expectation that when the coin goes down to like $2.2, maybe by 6%, that you want to take profit. This is your current price from the top. But if the market goes up against your, because you enter at the top here, you wanted the coin to go down to $2.2 price, take 6% profit, and the coin now went against you. So if the market is going against, because this is a short position, now this is the current. So any price that is under your entry price from up here, whether 2.9, 2.8, 2.7, as long as it's fluctuating below your entry price for short position, this is your current or market price. So if the market goes against you, the further the market is going against you, instead of it going down, your forecast and your target is going against you. The further it goes against you, it can lead to partial loss if with stop loss, and it can be liquidated completely. So that's one of the challenges in trading. But with proper analysis, proper strategy, proper management, you will be in order. So let me explain the next point. The next point is I want to talk about P&L. So the next is what is take profits and stop loss.
Now, TP, still using that same example, TP is you enter at an entry price, you enter a coin at $3. And TP also means trigger price. Trigger price. That means the price you want the coin to be sold. So if you take a long position and you enter at this entry price and you want to sell this coin when it gets to 3.8, so your take profit is 3.10. The price you want the coin to be set to for it to be sold and close that trade and take profit is called TP or trigger price. But if you take a short position, that if the coin goes down to 2.5, so this 2.5 is your TP. 2.5 is your TP. You enter at $3, you take a short position that if the coin goes down, you want to take profit, you want to take profit at this trigger price of 2.5. So this 2.5 is your TP, your trigger price, trigger selling price, trigger closing price. If it's a long position, if it goes up higher than your entry price, so the trigger price that you want the price you want the trade to close and give profit is the trigger price. I believe that one's understood. Now let's talk about stop loss, because when the signal is sent, you'll be seeing and those terminologies. So you need to have a basic understanding of all these things. Now, what is stop loss? What is stop loss? What is stop loss? Stop loss is this. You enter that same coin at $3. Let me talk about long position. That means you want to sell to close this coin at a TP, trigger price of $3.8. Now, if the exchange tells you that in case the market goes against you, this is the liquidated price. That if this coin gets to this price called liquidated price, you be wiped off, your account will be blown. So if you now decide that okay, before this coin gets to this $1.5, if it gets close to like 1.9, I want to put a stop loss here. Stop loss is that before it gets to this price called liquidation price or liquidated price, that will make all my money to be cleared. I have $50. And if it reaches liquidated price, all my money will be cleared. But if I put a stop loss, that please, the moment the coin goes to 1.9, please stop that trade. You might lose about $40, only $10. So the price you put the coin before you reach the price that all your money will be cleared, it called stop loss for long position. So if it is a short position, you enter at $3. You take a short position, that means enter a coin from the up, that it will go down to, I want it when it go down to, let's say $2.5, $2.5, $2.5, you want to take a profit of 5%. Now, market can go against you. Instead of it going down to give profit to you, it's not going up. So if you're not going up, the exchange will tell you that if this coin goes against your short position, instead of it coming down, it's going up, that your money can be that it might reach $4.5 high. So you want to put a stop loss at maybe if it reaches 3.6, I want to put a stop loss here. That before all my money will clear, if it reaches the liquidated price, please, that means it's going further up. So before I get to this place where all my money will be cleared, please end the trade. cut off the loss so that I will not lose my entire money. That's what is called stop loss. Now let me explain liquidated price or liquidation. I think I have been talking about that while I was explaining these terminologies. Now liquidation, liquidate, liquidation, and liquidated price. So liquidation is simply losing all your money in a trade. That's the name of it. That's happened to me before. I entered a trade called Vanary and I didn't remember to put stop loss, and the balance in my account couldn't carry the trade as the coin was going up and down. I woke up the second day, all my $50 cleared, disappeared. That's what we call liquidation. But when you want to enter a trade, whether short or long position, let's say you want to enter at $3, and the exchange will tell you the moment you enter you enter a trade, they will tell you that this is the price. Let's say you should take a long position. That this is the price that your entire money in your balance will be cleared if the market goes against you. Instead of you want to take $3.5 when it goes up and it was going down, that if you reach this price, they will liquidate you. So if you take a short position, you enter at $3, you want to sell the coin. When you want to close the trade and take profit, if the coin goes down to $2.2, you want to take like 7%, and the exchange that give you a liquidity price of $4.5. That if the market goes against you and started going up, the moment you reach $4.5, this is the liquidity price you'll be liquidated. So this is the explanation of what is entry price, what is market price, what is TP, what is selling price, what is liquidation, and liquidity price. So in the next video, I'll be talking about P and L, and I'll be talking. I didn't put it here. I'll be talking about P and L. That's the first I will talk about. P and L. I'll be talking about order by quantity, order by cost, limit market by order, limit market by order. Then I'll talk about this in a separate video. So let's wait for the next video. Thank you.
Okay. I think we spent almost 1 hour. I don't want the training to be too long so that we will not get tired. If the information is too long, we might get tired and it might not sink in again. So before I finalize today's training, I think I've made a lot of points on some terminologies. You can see the reason why I must not go straight to trade. I must not go at all. I must lay this foundation first, have this understanding first before we ever even think of trading. So that's why it's not good to be too aggressive to make money without having adequate knowledge how what you want to engage in works. So any question before I quickly go to the next agenda, then we'll call it a night. Any question for those people that have never done for anyone that have not done trading before, future trading before, I want you to ask question in any area with sharing and give us understanding of what some technologies means in futures trading. Please open your mic. If you have any question, you can type the question in the chat box. Please, if you have not done future trading before, please ask question. Or don't assume that you know, please. I can cite people that might not have done future trading here before. Please don't let us keep to ourselves. Ask question. Please ask your question, please. Or you can unmute your mic. You can unmute your mic or you can type it in the chat box. Okay, that means you have understood. Okay, if you have understood everything I've said so far, type 5 in the chat. If I've understood all the terms that I've been describing all this while, type 5 in the chat. We should be, it is a dialogue, not monologue. I shouldn't be the only one that is talking. So I can, let me know whether the message I've passed across, we understood it. Please type 5 in the chat if I've understood every terminologies I have explained tonight in features. Because if you don't understand all those terms, when we now start the features reading with RoyalQ, you will not be able to understand. If you don't type 5, that means everything I've said for almost 1 hour, I just wasted my time. I mean, it doesn't have any meaning to us. If you can't type 5, that means everything I've said so far does not have any meaning and does not have any value to you. That means I've just wasted my 1 hour talking all this while. So anybody that does not type, that means you don't understand. So if you don't type, that means you don't understand. Because to type 5, it will take only 1 second. So anyone that does not type, that means you understood what I've said so far. Okay, I will stop there. Anyway, I've already recorded the session. You can go and watch it all over again. That I won't go too advanced. So tonight, I just want to finalize today by telling us, most times you discover that I always send preset price in our channel. I send more of preset price. Why am I doing this? I'm very, very careful because of my past experiences of sending trades in market price that always make us to be stagnated. I don't want it at all. So sometimes when I send preset price, which is now called initial buying price, the trade might not start immediately. Because a lot of people will always be asking me, it's not running, it has not triggered, and this and that, because I'm trying to avoid us getting stuck. It's very painful when we enter trade and it's taking long to deliver. So like this signal I sent today, XLM, that was in around 7:59 a.m. in the morning. If we go and check the chart of XLM, you discover that it might not have reached that price because we are trying to avoid this spot trading. We are trying to avoid entering the coin too expensive because the lower price we enter the coin, the better. Because the market, market is having a tendency to crash. I won't say the word crash, no, I won't say crash. Market is having a tendency of pulling back because over several days, Bitcoin has been moving up, and you can see it's still moving up. Because it needs to pull back. Bitcoin needs to pull back. Let me go to the 1-day chart. See, for the past 1, 2, 3, 4, 5, 6, 7, 8, for the past 10 days, Bitcoin moved all the way from around 83,000 to the all-time high of 9. That's a massive move. And normally, there was supposed to be a pullback back down to at least 86,000 or maybe around this price. You see all this guy that you are seeing here? Bitcoin needs to pull back. People that bought it from here, all this green candle you are seeing, they are liquidity. People's money are there. People that are bought from here, some of them might want to sell and bring the price down, and it will cause correction in the market. Market must always undergo correction. So anytime there is a massive movement up, and after some days, you now see a lot of red. That's what we call correction or pullback or retracement in crypto. And it must always happen. It's a rule in trading. That's why I'm very careful in sending signals, because if you go and enter any coin at a very high price and the market retrace, it might take long for you to come back to that entry price. You can see from the daily chart for days now, this place on the RSI is not coming down. It's supposed to come down. That's why the bulls are really holding strong on the price. The bulls, the buyers are still taking charge in the market. That's why the market has only gone down. Because any small drop in Bitcoin, if Bitcoin just drop by -2%, you see what will happen to all the entire coins in the market. They will start going down. So that's why XLM that I sent, can see till now. Okay, it has now showed to 796 now. And I said we should enter it when the coin gets to 2785. So if I go to the 4-hour chart, the reason why I sent that signal was because it XLM is close to the oversold region. That means the stochastic RSI is telling us that they don't sell this XLM tire, so it must come up. That's why I was able to say that signal, and that's why I gave us that we should enter at 2785. It's almost close now. See the current price; it's almost close. So maybe in the middle of the night there might be a, see that purple line. That purple line. Let me show us 1-hour charts. If it is me, I might even tell us to go and even change this price to this place. If I need straight, please go and change this price to this place. Go and edit this. This is the price. It's almost getting close. See, it might slip and it might trigger here. The coin might still come down to this place. Because I'm seeing the sign here. On the 1 hour, the RSI is still coming down. So I will tell us to go and even, let me screenshot. Go and edit it. So how do we do that? Let me go to an account. So it's always good to always enter it much more lower, because the lower you enter, it's better you wait and let the market pull back, retrace, and enter lower, so that when it enter lower, it will be easy for the coin to start moving up, and it can make like 2-3%. But if you go and enter the trade around this region, let's say you have entered at around here and the market come down, you that will enter here and the market come down, if the coin goes up, it will almost get close, it might come down again. But if you enter at a lower price, you will enter here, it will go up, you get out of the trade and make your profit. But somebody that enter here and want to sell here, you that will enter lower, you sell faster than someone that enter here. So that's why I sent mostly more of a preset price. Even if I see a lower price, I will even enter, because actually this is where the coin is still going to. If there's a serious shake in the market, this coin can pull back down slow as this price here, this 2438, and you might not discover that you will not be negatively down by like -12%, and you might not like it, because you now see that okay, I started with $100, my money has now gone down by 12%. That's about let's say you have $200 in your Binance and the coin has gone down by 12% of $200. So your money now will now be -$24. You will now be calling me, my money is going down, my money is going down. No, it's because the coin you entered has depreciated in value. So the bot will keep on buying, is going down. When it now start going up, as it has bought it at different prices down, to be selling it. So that's why if now the coin depreciates with that -12% because you enter high, you might stay longer in that trade. Longer can take days, weeks. So it's better you wait and enter at a lower price, the coin pump, you get out, than enter at an higher price and the coin goes down. You now be waiting for days, even can turn to weeks. I don't want that. So if I want to now change this price, As it's already showing. Let me go and change this thing now. I even change it to 2706 because what I'm seeing here, anytime I'm seeing this dragging under the RSI, you can't be dumping more. So I'll go and change this thing to. So if I on this, we go and change this thing to let me check. This coin might dump to 2706. 706. Yeah. So let me go and change. So how do you change? You go to trade 2706. Go to your trade. Let me confirm that I enter excellent here. Okay, I enter excellent here. So what we do is that enter into the coin. You want to edit. Then pause. If you want to edit it, it's not allow you. Are you seeing it? I'm tapping the initial buying price, not allowing me. Okay, as I've even reduced it already, sir. So I'm not even okay. I brought it down lower. So 27 is already because I sense it might come down low. So if your own, so for you to edit it, pause first, confirm, then you put your N inside that place, then you can now change it to the new price you want. So then you activate. So until the coin go down to that price before the bot will now trigger, before you trigger to start running. Because we want to buy more cheaper. But so that I can get more. I don't understand your English. What's the essence of futures to sports? Please, I don't understand that essence. What's it? I don't understand. Is it what's the difference of future to sports? Please reframe your question. It's not clear. Or you can mute your mic. What is the essence of futures to sports? I don't understand that question now. So let me go to the edit. Let me type edit the inertia buy in resale price to 0.2706. So I'm stopping here. So those that are asking that question, AG DAC, please unmute your mic and ask your question properly. I don't understand your question. So that I will not know how to answer. Please unmute your mic and ask your question, please. I don't understand that question. AG DAC, please unmute your mic and ask the question. Are we not hearing me? Please, if you are hearing me, type 5 in the chats. I don't know when I'm telling us to ask questions, we don't respond. Are we hearing me? See myself, I'm talking to myself. Oh. Yeah, it's very, very possible, sir. Very, very possible to change your, it is in RoyalQ that we use preset price. In normal trading, we call it limit price. I'm going to talk about that one on Friday when I continue. That question you're asking me, I have already said it in the beginning of this training. So I don't like to be going back up and down. If you like, it seems as if I'm repeating myself. And I think that should be Mrs. Jacob. You know, you have already paid for this course and you have listened to it. And the video, when I started this video, I have explained the difference between the spot and futures. Please go and watch the recording, please. But this should be the third time or second time that you are trying to understand the difference between spot and futures. I've explained in this video. Sports, you can only buy when the market go down in sports. But in futures, when the coin is down, you can buy. And when the coin is up pumping and you want to make profit is coming down, you can also take position and make profits. In sports, any coin that you buy in sports market is your own. But in futures trading, any coin that you buy in futures market is not your own. It's like you are borrowing. It's a contract. It's a contract. And in sports, there is no leverage. In future, there is leverage. You're already trading now. I believe you should understand it better. The only advantage of sport futures is that number one, any asset that you buy is your own. So if the market crash, you cannot be wiped out. If the market goes against you, you cannot be wiped out. Any asset that you buy, any coin that you buy in the spot market is your own. And if you buy that same coin in futures market, you are not owning it because you are using leverage. You are having a contract with the exchange. So it's like any asset you buy on the futures market you trade is the exchange that owns it, because you are using leverage to purchase that coin on contract. You are having a contractual agreement with the exchange, and any coin you're trading there is not your own because you are using leverage. You are borrowing. That's the easiest way I can explain it. But on spot, you are in charge of your assets. So that quantity of assets you have is your own. So whether the market goes up against you, you cannot be liquidated, you cannot lose your money. You can only experience the precision of the value of the coin that you buy in spot. So that's the major difference and the essence of spot to futures. So any other question? So let us stop here tonight. I don't want this video to be too long. It's almost 1 hour.